Okay, putting the information for the next trade. Just give me 1 second.
So right now we're live, Jose?
Yes, we're live now.
Okay. Okay. What he was as nervous as I've seen him, and the commentary, Craig, like what spooked the market? What was the one or two lines that spooked the market? And by the way, when markets speak, trending now on Amazon, a bestseller, and everything in this book is really about what happened today. It's a must read. And the summer's still cooking along here for another couple of weeks. This is the best summer read that you can buy. Craig?
Yeah, look, I think, with respect to, let's say, the equity market, this is options expiry week. Options drive, an incredible amount of flow in any particular day, and then certainly an options expiry week. So we have crazy moves
Yeah, but
intraday.
what did he say that?
No, so I'm saying that the market's been basically all over the place. Is the kind of, so I think it's hard to read.
But during the conference, it rolled over,
The one comment that I think that spooked people is that he mentioned the higher neutral rate. And so
and look at the curve right now. Look at the curve. 30s right now are up 6 basis points.
Right. So basically that's his what he's saying there is, the error of low rates that existed pre-COVID. We're probably not going back to something like that. There's been structural inflationary forces in the economy that, lead us to an environment where the neutral rate, which is the level of interest rates where the economy is largely in balance, is higher today than it was prior to COVID. And I think that was the comment that rolled the market, because it suggests that the amount of easing that the Fed will be able to do without inciting more inflation in the future, that amount of cutting is lower than people realize. And I think that's the comment that I think maybe rolled the market a bit, got the bond market to sell off, stocks started to turn over, the dollar found a little bit of a floor in that comment, gold fell over. So things seem to coincide with that comment. Is everybody listening and so finely tuned to that comment? I'm not sure, but certainly that seemed to have some elevated importance.
Hey, Robert, the message of the meeting, right? Doesn't it come down to they're willing to deal with a little bit with higher inflation but they really are more concerned about the labor market now than inflation. I think that even though they said it's balanced, it feels politically and for a whole bunch of reasons they're more concerned about the labor market than inflation. What's your take?
Well, I mean, Nick Timiraos just tweeted. He said that the comment about the neutral rate was actually dovish because,
It was dovish?
yeah, because the real neutral rate during the dead zone between 2010 and 2016, 17, basically, was that the real neutral rate would actually dip negative, right? So you don't want that. So a real neutral rate positive, is for all intents and purposes can be seen as something that you don't have to go back to that environment whereby you have
Now explain to people what the
basically.
real neutral rate is for the average, non-Wall Street person, somebody, middle class, like middle class investor. Like, what is the real neutral rate? What does that mean?
A negative real neutral rate is where your rate is basically is the potential growth rate is negative, and your inflation adjusted, you're looking at negative rates. So I think that's a sign that an economy cannot grow, that the Fed is pushing on a string, and that's not the case right now. So when we saw that, of course, during the period of 2010 to 2016, 17, that's why the Fed had to do this quantitative easing constantly. And if you're honest as an if you're economist, if you're an honest economist, which is hard to find these days, you really have to admit that it didn't really work. Quantitative easing for the real economy, it worked great for the stock market, but it didn't really work for the real economy. So I think avoiding that kind of territory, I think that's what he meant. And I think that's for all intents and purposes, the problem with Fed Powell is, and we talked about this before, is he is no Alan Greenspan, right? He may not even be a Ben Bernanke. He talks way too much. And he, with Alan Greenspan.
Yeah, but what's this mean for investors? You know, like someone like what if you're an investor watching the show, like what
Well,
they
these are
take
very
from this
important
besides
implications
besides the fact that you don't like Powell, you know?
well, I like him perfectly, but for investors, it means an additional layer of uncertainty because you never know where the guy comes from, right? I mean, this weekend he had their mouthpieces talking about 50 basis point rate cuts. Then, he brings out a coterie of former Fed speakers this morning saying 25 basis points, and he surprises the market by 50 basis points anyways. But he never was able to coach the market into fully pricing in those 50 basis points of cuts. And we talked about this before, is that the forward guidance was something of a holy grail with the Fed, right? They were hell-bent after the financial crisis to make sure that the market was fully pricing in every single move before the move happened. And he failed to do that. Right back in June, he was still talking hawkish. Then he made this dramatic pivot, and we've seen him doing this over and over and over again. Back in January of 2022, when Ukraine was run in by Russian troops and oil went to $125 a barrel, this guy was still doing quantitative easing. Right. And the end of 2018, when the market rolled over, all the signs were signaling a recession. This guy was still talking hawkish. This is a very unpredictable Fed chairman, and I'm afraid to say that we're going to sit with him for a while. So that level of uncertainty.
So what's it mean for investors? Where's the
market.
trade? So let's talk about it sounds like we're lecturing people about Powell, but let's think about
No, you're asking what the implications are for markets. The markets don't really know. So when he says like every meeting is live, which he repeated basically, we're dealing again with uncertainty that comes out every time important data points come out. Right. So heightened uncertainty when every time a labor market report comes out. Because you don't know. So God forbid non-farm payrolls come back at 250,000, even if they're doctored up numbers. Then all of a sudden Powell is back to, oh my God, we can't cut anymore.
So Louis Bacon, one of the guys said in the chat, Louis Bacon is famous for saying the breadth at which they do more than was priced in speaks to how dovish they are. In other words, 50 bips when the market, when the market wasn't fully expecting that is the most profound, more dovish than expectations, even though they tried to talk that back. But by doing 50, and the market wasn't fully priced for that, because at some point this week we were 50-50 on 50, right? Where were we like earlier in the week on 50 basis points?
We were at 72% this morning, and then we were at 55%. And
yeah,
so it's been very hard. And I think the action today makes it even harder for rates traders to price in the next move, and it makes data reactions more volatile, inherently more volatile, right? Because you don't know how quickly they pivot. How quickly they changed their mind. Clearly, they probably didn't even know what they were doing yesterday. Remember, the Fed Open Market Committee meets 2 days, right? So the meeting started Tuesday. That we might even conclude that they didn't really have a definitive plan yesterday of what they were going to do today.
okay,
and that's not good.
okay,
That's not good.
So look at how much they've been easing already. So they have taken the 30-year just by their vocal cords. The 30-year Treasury has gone from 8.1% to 6.6. Craig, in the chat today, people are talking about home equity lines of credit. People are talking about how much equity there is in the homes of Americans. The refinancing kind of. I think you mentioned in the chat today, there was a couple of clients. They're talking about the spike in refinancing, right? So how much, like some people think that could re-accelerate inflation, because if people can now access equity in their homes, it's going to be tough to get inflation down if that's supporting inflation.
Yeah, I think it's a little bit of a mixed bag, but because the folks that can refinance mortgages with rates still this elevated are people who bought homes in the last 2 years or so, where the price appreciation on those homes has not been so aggressive that there's going to be this mass, cash out refi wave. But what I think what winds up happening is people who do have those high rates of mortgage, maybe they're lower FICO score borrowers. I know there's a chart that was in the chat about that. Those people can use that extra cash from lower rates to help them, purchase other, durable and non-durable goods. So I think if and when mortgage rates, fall another 100 basis points, because growth really does start to slow, then you start to eat into more of the mortgage component of people who may have, locked in gains on their homes. But broadly speaking, look, I mean, there's anybody who's borrowed money to buy a home in the last 2 years is going to be able to refinance that cap.
Yeah. So bottom line is,
so it matters. It's just, is it how big of a driver of consumption? It's hard to say, but it should help on the margin. Wallet share for lower income borrowers can pay less out of interest and can buy more food, gasoline, and other non-durables.
yeah. So this speaks to, so you have the point that we made earlier is that core CPI is 2 standard deviations. Talk about super core. It's much higher than the 2010 to 2020 regime. And everybody is still in the 2010 to 2020 portfolio. And the point that we make in When Markets Speak, a bestseller on Amazon, is that you need an entirely new portfolio. And so if they haven't killed inflation and they've been advertising cuts for the last 6 or 7 months, the last 6 or 7 weeks, especially the last month and a half, and you could see by the lowering the mortgage rate, by talking rates down, they've got this big move in refinancings on that page there, and that's probably going to somewhat support inflation.
Yeah, look, I mean, they're making these decisions with, headline inflation, still running well above target, core inflation well above target, services inflation still well above target. Yes, they are comfortable in their models that we're going to return prices to 2%, but their models have proven to be very inaccurate for a lot of reasons, since COVID. And I think in a world of escalating geopolitical concern, the need to duplicate supply chains, the U.S. has to build out its own domestic industry. Europe needs to build. You have, an increasing trade tensions between the West and BRICS countries. These are all inflationary dynamics that are likely going to overwhelm any AI productivity gains. And so I think we're going to be in a world where inflation, struggles to get back to 2% and is more likely to find a home in the, let's say low 2.5%. And if the Fed is then starting to cut rates more aggressively, which look, they may not have met expectations of where the market wanted rates to get to, but they're still going to have over 200 basis points of cuts coming. It's more likely that we're going to get a fall in the dollar. It's more likely that we're going to get a rise in commodity prices versus the dollar, maybe not the next 3 to 6 weeks, but certainly over the course of the next 9 to 12 months. And that's where I think, folks have to be concerned about an environment where inflation really doesn't get back to target. And for most Americans who are living with high price, even Powell said it today, people are still living with these high prices, right? Inflation is just a rate of change of price increases. And so most Americans we're still dealing with 25, 30% price gains, since COVID across a wide swath of goods. If the rate of the increase falls from 3 to 2, great. But we're still having to deal with, the impact of that 30% increase that we've had over the last 4 years.
And so here you got right now the 10 years up 6 basis points higher, so 6 basis points higher in yield. Twos are up 1 basis point. So the curve is steepening. So this chart is actually going further. So the higher that line moves, the steeper the curve, right? So we're typically as you come into recession, 2s 10s goes from inversion to back to out of inversion, and so that's what's happening now. We're probably we're well out of inversion, right? So we're breaking out here on 2s 10s.
Yeah, I mean, people look at the inverted yield curve as a sign that a recession is coming. This has been the longest that the yield curve has been inverted I think maybe ever.
Yeah, it's almost 2 years.
And so, but typically the sign that we've actually triggered into the recession is when the curve steepens back out again, because it's a sign, and particularly when we bull steepen, because that's a sign that the Fed and interest rates in the front end of the curve are starting to move lower. So it's that acknowledgement that the recession or the growth deceleration is finally here, is what signals that we're in that recession. Now, the Fed doesn't believe that we're in recession, and most economists don't believe we're in a recession. They think that this move to cutting rates is really more about normalizing policy and making sure we don't fall into one. I think the jury is still out. There's been segments of this economy that have been in recession for quite some time. Certainly, rate-sensitive parts of the economy have been in recession for quarters now. Manufacturing has been well below normal. Manufacturing PMIs, is the Purchasing Manufacturers Index, has run below 50, which suggests recession. That's been going on for the last certainly all year and probably for the last 18 months. So segments of the economy that have already been in recession, the Fed is now looking to start to address that with lower rates. But now the labor market is starting to soften, and things could things can get worse.
So Rob, you built this chart, and this chart is in our book, When Markets Speak. And the dirty secret is there's a cottage industry of economists, right? That they want you, when you watch CNBC, when you watch Bloomberg, they want you to need them, right? So there's economic data that's somewhat important, but at the end of the day, if you have this kind of debt maturity wall, Robert, $3 billion of debt, $3 billion of debt interest payments every day, 1.1 trillion of interest payments per year, and the average, get into the average weighted maturity, Rob. So the average weighted coupon, which you talk about in the report and in the book, the average weighted coupon. So what did Yellen do here? And explain it for the layman.
Well, this
Isn't this why they're cutting rates? I mean, the point is, the economic data means nothing relative to this.
What we're looking at here is the annual maturities of debt in the U.S. debt. So we're looking at $5.5 trillion that is maturing this year. Another $4.5 trillion that's maturing in 2025. But that will obviously increase because a lot of the treasury, the government debt will be funded with short-term maturity. So they constantly have to be renewed. That's why we see all those 3 and 6 months and 4 weeks and 8-week bill auctions all the time.
So let me explain this for everybody at home. So into an election, you have an administration, just like any administration, they want to stay in office, right? So Janet Yellen, Rob, she issued tons and tons of T-bills because T-bills don't move. In other words, she pulled volatility out of the market. If a bond matures in 6 months, and rates go up, it's not going to move in value. But if they had issued, say, if Yellen had issued, say, 2 trillion or $1.5 trillion of 10-year bonds and 5-year bonds, those bonds would have moved like this with interest rates, right? So is it fair to say that into an election year, she essentially tried to keep bond volatility lower by issuing tons and tons and tons of T-bills, and now somebody has to clean up that mess?
Yeah, well, this is a mess that has been long in the making, right? Congress has been woefully irresponsible by running $2 trillion deficits year in and year out for no good reason, honestly. So they have to renew this. Maybe you could argue one reason why the Fed was so aggressive in cutting rates now is because they realize that they're up to a maturity wall. So all these debt has to be renewed.
And then what's the average weighted coupon? So in other words, as these bonds come due, the average weighted coupon is what, and what would it go to?
Well, the average weighted coupon was around 2.5% to 3%, but they'll have to refinance it at that point. The Fed funds rate was 5.5%. So if they issued short-term paper, they were actually having to pay now 5.5%. Now the Fed cut rates, so now we're closer to 5%, but it's still at historically very high rates. Now you could say, yeah, in the 80s it was 10% or something like that. Yes. But in the 80s, our national debt was 2.5 trillion. Now it's 35 trillion, right? So we're talking very, very different numbers here.
So if they didn't cut, if they didn't cut 50, or if they didn't cut 100 soon, that average weighted coupon goes from like 2.5 to 3 up to maybe 3.5 to 4.
Right.
And that means your interest per day goes from 3 billion per day to maybe 4 billion per day, or annually might go to 1.5 trillion. Is that correct?
Yeah, that's why we're staring at a interest servicing cost. So it's not even paying down the debt. It's not even debt, like reducing your debt level. It's just servicing costs are so high now, they're exceeding the defense budget, right? With over $1 trillion per year. It's an astronomical number, but no one in Washington, D.C. seemed to be bothered by it too much. And even if you're thinking about it, you're wondering, okay, maybe they'll save a little bit on interest cost because the Fed has cut rates. What are they going to do with that money? They'll find another source to spend it on. But so that's a really troubling sign. But what's more challenging, I think, for Janet Yellen is that she was able to finance a lot of the short-term maturity debt through the reverse repo facility, right? The well-known RRP facility that was built up during the Corona crisis to the tune of 2.5 trillion dollars. So there was $2.5 trillion sitting on the sidelines in the reverse repo facility that was deemed excess liquidity, or that was, that could be converted into excess liquidity. It was essentially outside of the, if you will, the short-term liquidity pool. And what she has done, especially since Congress raised the debt ceiling in May of 2023, is that she basically has transferred a lot of that RP funding, to keep it very simple, the pool of money that was in the reverse repo facility into the bills market. And she was, and the result was that she basically facilitated a very smooth issuance of short-term
why
debt.
should investors care about this? Why is it
Because it's
important?
empty now, right? The RP is down to 250, 300.
But why should people care about that?
Well, it basically will lead the Fed, or will force the Fed to stop quantitative tightening, right? In the not too distant future, because the Fed keeps it
That's
very.
why there were a couple of comments, there were a couple of questions about this today, but they didn't ask the question the right way, but there were questions around QT, quantitative tightening, right?
Right, because the Fed doesn't like to see that facility draw down to zero. Since the end of August, it drew down by 200 billion. Now there's some moving parts to it, but the bottom line is that it's likely going to be depleted before the end of the year.
Why should investors care about that? Creates more volatility in the market?
No, because QT has essentially been mopping up liquidity out of the market. It's been a drag on risk assets. So the Fed has cut back on QT already.
What does that mean for the investor? Like, why should people care about that?
Well, it's bullish, right? If the Fed stops quantitative tightening, it's bullish. So that's something to keep in mind. And it's definitely.
It would also be bearish for the dollar. Bring up the Palladium chart, Jose. Hard assets. If the Fed reverses the policy on quantitative tightening, that's easing, right? And that gets you a weaker dollar, and that gets you a real move. If the dollar gives way here, then your hard assets. Remember, there's 23 trillion in the Nasdaq 100, and the entire energy space is only worth less than 3 trillion. And so the entire metal space, like platinum, palladium, there's no money. There's literally very little money in hard assets in American investment portfolios. As you can see here, we had a MACD cross. The MACD cross isn't here, but the palladium and the MACD cross on palladium, all that means is a very bullish indicator of a potential really game-changing move. You've seen ags this week, agricultural commodities. Palladium's having a bad day today, but 35% move in palladium in the last couple of weeks, 3-4 weeks. And
Well,
so,
what's interesting is actually the Japanese yen really strengthened to a 140.5 after the Fed meeting, right after they announced their 50 basis points. It now completely reversed, and it's at the lows of the day now. It's at 142.4. So that's kind of an interesting development, which is somewhat unexpected, and people watch it. Now, ironically enough, it's been the yen that has been driving the carry trade reversal since the beginning of August, right? With the strengthening yen has pushed people out of the carry trade, which has led to this dramatic market sell-off on August the 5th. Now the yen is weakening, but equities are actually at the lows of the day.
I got you. So,
I think it's I think
yeah, Greg,
it's a
go
little
ahead.
bit of like there's like a timing thing which everyone needs to be aware of, right? There's these structural deficits in the US which are not being addressed. And if we go into a recession, they're going to be larger and necessitate lower rates, a weaker dollar, and that's going to be very constructive for all hard assets, gold, palladium, precious, anything. But we have this near-term period here where the economy is slowing globally, and in the U.S., it's also starting to show signs of slowing. So from a nearer term perspective, it's like we're in a little bit of a race here. How quickly will the Fed bring down interest rates in order to address the growth decline? And can they do it in such a way without inciting this inflation that we're all talking about and believe is coming and want to be positioned for next year and years beyond? And so I think that's what we're trying to parse for. My concern right now is that with the economy slowing, these interest rate cuts, they're not going to be stimulative. They're not going to do much. People are going to say, "Oh, you gave me 50 today. Why should I go and borrow money
But
now?
remember,
I'm going to wait
mortgage
because I
rate.
know another 50 is coming next week
Yeah, but
and
remember,
after."
mortgage rates are already down 100 bips. So the market's already priced
No,
in
no,
a lot of these.
I understand. I understand. I'm just saying that people in their real lives are not seeing a better economy. People are not seeing lower prices yet, and people know that housing is still largely unaffordable. So we could get into a situation where, as this rate cutting cycle commences, folks say, you know what? If I know rates are going to be lower tomorrow or in 6 months, I'll wait. And so, you add that to the election uncertainty that's going on right now. I think we're still likely to see this growth scare between now and the end of the year that necessitates more aggressive Fed cutting, which then brings forward that timeline and allows us to be very comfortable about these hard asset trades and these commodities. So I think from an investor point of view, not getting too aggressively long risk right now makes a lot of sense. And with respect to just bonds, folks have used bonds as a ballast. The yields on bonds, for a long time, 60-40 portfolios of equities and bonds. I think the key takeaway for me is 40% weights in fixed income of long duration U.S. Treasuries seems like a horrible idea. And I think people should be thinking about allocating capital away from that bucket of, 30-year yields at 4% are just too low right now to deal, to lend money to the U.S. government for 30 years. So I think that's what people should be thinking about as positioning portfolios for next year, is allocating capital from the bond U.S. Treasury risk budget towards hard assets. Start with precious metals, start with gold, and kind of work your way down into some more of the more cyclical metals as we get further into this growth deceleration, such that the cutting, when it happens, actually starts to work and to matter.
Yeah, so today you have the copper miners are up 2% with the NASDAQ unch, right? So copper miners up 2% with the NASDAQ unch. Hard assets also.
But oil's down 1.5% now, right? So I mean, it's not, again, I think it's hard to take too much away from the first day move. I think, so let's say 6 to 9 months from now, being long hard assets, copper miners, shifting capital towards that and away from big tech, where valuations are egregious. I think that makes a lot of sense.
And so now, one of the things that clients have been saying in the chat, so we run a conversation with institutional investors behind us. It's one of the largest platforms in the world where we talk to hedge funds, mutual funds, and pension funds. But everything that worked, Rob, into the Fed, so the XLU, obviously the staples, everything was working into this Fed meeting is now reversing today. What's the driver there? And that probably continues. The bottom line is you might want to be looking at bearish trades on the utilities, bearish trades on the staples.
Well, so the case was that money rotated into defenses in the summer, especially after mid-July, because there was a growth scare. People suddenly came to realize that the labor market was not that strong. You had a very soft CPI read. So people basically stampeded into defensives, and there are not that many defensive sectors in the U.S. As a whole, it's a decent
Now
part of
explain what defensives are. So
it's therefore it's as a
recession
whole
stocks.
it's a pretty decent sized chunk of the market, but it's mainly healthcare. So Eli Lilly is the big kahuna there. Merck as well. And they've been the best performers. They're utilities and real estate. They're basically two peas in a pod. But utilities have generally done a little bit better because there was an AI component to utilities as well, right? The growth in power demand. And then there is staples. So the Procter and Gambles, the Coca-Colas of this world. And they have been the best performers in the summer, and at the expense of value, actually, as well as growth. So, and that was also done because empirically, these sectors do the best into a Fed rate cut. Now, I think the market will have to grapple with a new reality, which is okay, the Fed has cut, but it's cutting into an economy that is rebounding from the summer doldrums, right? You saw the economic data, Empire State, manufacturing came in better, retail sales came in better. Recently, Restoration Hardware came out and said that August and especially September was a much better month. Toll Brothers said the same thing. So you're seeing a whole bunch of anecdotal evidence that things are picking up into the fall and into the fourth quarter. So that means you don't want to be in defensives now. That trade has been very overextended. We talked about Philip Morris and its brethren, Philip Morris International, yesterday. So there's the PM and then there's MO, right? They're basically, the PM is the international tobacco side and MO is Altria, which is the domestic tobacco side. I mean, those stocks, which make horrible products, they've been running like crazy, right? They're like a textbook staple. And I think that that's a sector where you want to be away from right now, because I think the market will revisit both the value and the growth side of the economy of the market, realizing, hey, we got our 50 basis point rate cut now, and if the economy picks up a little bit, then I need to be out of defensives. So that's what you're seeing today as well, right? Utilities, consumer staples, real estate, even some of the financial. Some of the defensive financials are trading lower, whereas the regional banks that love rate cuts are trading one of the best performing sectors in the market. And I think that that's a very interesting place to look at.
And so like JP Morgan's been a big hideout, so that's underperforming today. What's driving that on JP Morgan?
Well, Jamie Dimon, he's the first who will tell you that, we're going into a high inflation environment. He's been Cassandra all this time because he wanted to convince Jay Powell to stay high on the Fed funds rate because he's making a killing on that stuff. Just the money that they parked with the Fed is, paying him a very handsome return. It's risk-free. It's basically risk-free money. But now Fed funds rates are coming down, and the money center banks, which is JP Morgan, it's Citi, it's Wells Fargo, it's Bank of America, are essentially negatively impacted by a lower Fed funds rate, where the regional banks are very positively impacted by lower rates. The reason is that people don't have a choice. They have to bank with JP Morgan, and and Citi and Bank of America. So they're loath to take their money out of deposits there, but they're much more inclined to take it out of deposits at the regional banks and put it in money market funds, which have a much higher fixed rate of return. So that's why the deposit beta, right? The amount of money that is sensitive to higher rates, that is moving away out of deposits for regional banks, is much higher than for the money center banks. So if rates are coming down, then regional banks have a much better grasp on the deposits, where for JP Morgan, it doesn't really matter.
Yeah,
That's
so
why
so as rates went up, all the money ran into JP Morgan, and now if rates come down, some of that money is going to come back to the region.
It ran into JP Morgan, it ran into money market funds. Now it has a motivation to move out of the money market funds. Where it will go, some say it will go into the equity markets, others will say go into the credit market. But either way, for regional banks, this is a much better scenario than for JP Morgan and Bank of America.
So on high yield, this chart here, we're starting to see some clients short high yield. So think of the HYG. The HYG is now below 7%, which has come way down. The yield on the HYG, as you can see here, the SJB, this fund is short the HYG, so it's short high yield, pays 5%. But it's interesting that, so if you're worried about the economy and you're looking for a hedge here, you want to be thinking about short high yield bonds, which have moved. The yields have come way down. The bond prices have come way up, right? So if there's economic risk because the Fed's tipping their hand that they're concerned about economic risk, that's why we're starting to see some institutional investors starting to short high yield. Jose, next chart.
Hey, Larry, just for me, I just got to jump off here.
Okay.
And I will chat with you later, but thanks for having me.
Okay.
Thanks for having me on.
Thanks, Craig.
All right.
And so this is what Rob was talking about earlier around utilities. So if the long end right now, the 30 years up 7 basis points now today. So the longer end of the curve is higher, and the XLU, as we mentioned earlier, is trading the highest percentage above its 200-day moving average ever in the history of the ETF. The X is close to 20% above the 200-day moving average. So everybody going into the Fed meeting has been crowded into these defensive trades, as Rob said. We were starting to see the last couple of days in the chat, working with the institutional guys and gals, we're starting to see people short the utilities because the XLU, like I said, has never been this extended relative to the 200-day. And now with interest rates up, bond prices down, utilities suffer there. And so this is something that we're seeing some players buy funds like the STP. And this is, once again, speculative. You should levered ETFs, you cannot own them long term. But it's just interesting to see that capitulation. That's a very substantial puke going into the Fed meeting. And now if you look at the SPD now, let's see what it's doing today. SPD, one second.
SDP.
SDP. So that the SDP here is, so it's up 3%. So it's coming out of that capitulation puke right there. And so the utilities are really rolling over pretty hard now. And that probably continues for the next, at least the next week or two. But Rob, any closing points? I think, now equities have rolled over a little bit more. The bottom line is, what my take is, the Fed has to cut rates. Interest on the debt is too high. Forget about economic data. Economists want you to believe their narratives because they want your ear. But interest on the debt at $3 billion a day, 1.1 trillion a year. That's all you need to know. They got to get rates down. They are concerned about China. They're concerned about global growth. The dollar's been strong for a long period of time. Rob, get back into the China trade. So when the Fed cuts rates, I think look at JD, look at K-Web outperforming the Qs. So the Chinese equities, why does a softer Fed allow China to finally ease? And that's first question. And has a hawkish Fed prevented China from easing? And that's suppressed Chinese equities. Can you get into that for a second in closing?
Yeah, well, the China has an implicit peg with the US dollar, right? So the renminbi is anchored to the dollar. So they do not want to lose their competitive advantage. If the dollar weakens and the renminbi or the Chinese currency stays at a higher level. So that means that for you as consumers, Chinese products become more expensive. So that's why it has a peg. That's why it's anchored to the dollar. So every time the dollar goes down, the Chinese currency goes down and vice versa. So what that means is also that essentially China has to implicitly follow the Fed's or the U.S. Monetary policy, right? They cannot deviate too much from it because it would have to endure excessive outflows or
So,
inflows, for that
so
matter,
the
if it
strong
deviates.
dollar, so the strong dollar and the Fed higher for longer, higher the last year, higher for longer. That's in some ways been preventing that's been preventing China from aggressively easing.
Yeah, they can't deviate from Fed policy. So they have had to run a tight monetary policy in line with that of the Fed. But the Fed has been coping with very high inflation, right? In 2022 was 9%. Last year was still right around 5%, depending on which metric you look at. But China's inflation has essentially been negative, right? So that means that real rates in China are much higher than in the United States, because when you look at real rates, you're basically subtract the rate of inflation from the benchmark rate. So for the Fed, that means 5.5% Fed funds rate minus 3% inflation. So your real rate is about 2%. Whereas in China, the rate was somewhat equivalent to 4% or 4.5%, but there was no inflation. So the real rate was twice as much as it was in the United States. It's been very debilitating for an economy that's already suffered from COVID, the property bubble bursting, all kinds of onerous trade tariffs from the United States and from Europe and other countries, a smorgasbord of headwinds that China is facing. And on top of that, they had to run a very tight monetary policy, much tighter than here in the United States, because the differential between inflation rates. So that's why our call has been for a very long time is that to wait, or at least to see the Fed pivot as a sign that China could actually be bottoming and could actually start to act better. Now, sentiment around China is extremely negative. The local market, we're not talking Hong Kong here, but we're talking about the local Chinese market, has basically is at multi-year lows. That's the Shanghai index. So there's very negative sentiment. The Fed basically started with a rate cutting cycle, so that you're looking at Chinese growth outlook has been lowest in 3-year history, right? Very few
Yeah, so
people
look at this.
expect
So this
China.
chart, people are more negative now on China than they were coming out of COVID.
Right. Well, the argument there was that, okay, China's going to ramp its economy like crazy, but it never really it never really materialized. So people threw in the towel, and they have been throwing in the towel. And the one wild card is, of course, is what's going to happen with the U.S. election, right? So if Kamala Harris wins with a divided Congress, that's probably bullish for China. If Trump wins with a sweep, it's probably bullish for China because he's going to focus on tax cuts first. If Trump wins with a divided Congress, that means that he cannot do anything fiscally. So he will have to, by default, revert to trade policy, which is at the purview of the executive. So Congress has nothing to do with it. So then he starts to focus on China and maybe even Europe and other trading partners that he deems that have been cheating on trade with the United States. So I think that that's probably one of the last issues that is hanging over China, but we'll know where that's going to be um, after the election. And chances are that Trump walked back much of his harshest rhetoric after the election, and that could also spark
Right. Yeah.
some sort of a relief rally, even if he wins. We saw it in 2016. So this is just election season rhetoric, but that's probably what's holding back China still.
Yeah, I'm with you there, Rob. Thank you for that. Couple things, just housekeeping. When Markets Speak on Amazon, a bestseller. Anybody that wants to join us at the Bear Trap Support, reach out to Valentina at thebeartrapsupport.com, Valentina at thebeartrapsupport.com. We democratize information. We have the largest platform in the world that caters to both professional institutional investors and retail. We want to give retail investors a lens on that buy-side conversation. What are the professionals doing? Forget about the street. Forget about the banks. Street research is full of biases, full of deceptions, and you want to look at Hedge Eye. You want to look at the Dirt Nap. You want to look at Bear Traps. There's a whole portfolio of services out there for investors that weren't there, say 10, 15 years ago, and it really is about democratizing information. Thanks very much. We appreciate everyone. Robert, Craig, we'll catch you next time. See you at the top.